It's Fed Day. What's going on, guys? It's Hunter. Welcome back to another pre-market warm-up. We have another busy day out here. We have the Fed rate hike announcement coming at 2 p.m. followed by a meeting with Powell himself. So we'll go through and see what he says there. But, we don't have a crystal ball. We don't know what they're going to come out with. So instead of trying to front run the Fed and figure out what they're going to do, all we can do is look at the market signals and see what they are signaling in the short term, contextualize that within the longer term trend. So if we take it to our trading view chart here, last week I mentioned that, in my opinion, one of the most important signals to pay attention to, especially into the Fed meeting, was the dollar. So, the dollar not breaking down last week, really just sitting around the low end of its volatility range for a couple days. Yes, it provided some relief to the equity markets in the short term, but like I said, it never broke down, never had a trend reversal, never even lost 1 month price momentum. Yesterday, we had a nice move in the dollar, and we also saw that inverse correlation between the dollar and the S&P start to strengthen. So dollar up, stocks down. That's essentially how that trade works there. So you have to look at everything here. You can't just look at the S&P, look at it that it seems like it's breaking out. You have to look at all the other factors, especially those that have extremely strong inverse correlations to the S&P. We mentioned last week in our pre-market warm-ups that if the S&P truly did bottom, you'd see a major rollover in the dollar, right? So, it might have looked like a topping process for a couple days. To me, it just looked like a correction to another higher low, and, we got that bounce that we were looking for there. So that obviously hammered stocks, hammered crypto over the last couple days. Great short selling opportunities last week. If you remember back even, I think it was on Wednesday, we had our most, or at least the most overbought signals that I've seen in quite some time. I think we had over 150 individual tickers signaling overbought. A lot of those were small cap, a lot of those were retail. Retail was the worst performing sector yesterday, so some great short selling opportunities there. We'll get into the dashboards later, but they look a lot different today as they all basically went from the top end to the low end of their range within 2 trading days. So like to see that if you're on the short side. But another thing that I want to mention, and this is another big signal, you've probably heard it all week. Everyone's talking about it. I even made a video last night on TikTok and Instagram going over the yield curve and kind of the implications that that has on the market, what it means for the longer term trends. So I want to just break this down and show you why it's so important. So if we take a look at this chart, this is the 210 spread. So the 10-year yield minus the 2-year yield, that gives you your yield curve. So it's actually even lower this morning. It's at negative 26 basis points. But yesterday you can see we hit our lowest level since 2000. So definitely a big deal. The yield curve has a very strong track record of front running recessions. And the reason for that, so when you take the 10-year yield, that basically moves off growth and inflation expectations. So when you start to see the 10-year yield crater and come in, that shows that investors are not confident about the economic outlook as growth is starting to signal a major slowdown. Now, the other side of that, when you have the 10-year yield coming down, the way you get that inverted yield curve is when the 2-year yield goes up, right? So it passes the 10-year yield. And the reason for that is that the 2-year yield mainly trades based off the Fed expectations. So if you see the Fed start to enter an aggressive hiking cycle, which we are currently in right now, that's when the 2-year yield starts to rise. So basically what that signals is that the Fed is tightening into a major slowdown, which is obviously the worst setup that you're going to have for really anything, any type of asset, is when the Fed is tightening while growth is slowing, right? So there's really nowhere to hide during that setup. And that's what the yield curve is signaling. And that's why it has such a strong track record of front running these recessions because, like I said, that's pretty much the worst setup you can have. Now, the difference between this year and looking back 2019 or even looking back in 2006 was the Fed actually cutting rates into that environment. So yes, it was a nasty economic environment. All the fundamentals were working against you, but you had the Fed there to support it. I'm sure many of you remember last year, as soon as COVID hit, you saw the Fed start cutting rates aggressively, basically right away. So the setup that we had last year was back at the end of August, the yield curve inverted. Everybody knows what happened early in the year when we had March in 2020. The markets crashed, everything happened with COVID. But then right after that, the Fed stimulated into that and help drive the economy up even higher, drive the market up to new highs. So now we're starting to see that major acceleration roll over in terms of growth. Now, the only difference is that the Fed is perpetuating that move lower because they are tightening into this slowdown. So that's why it's such a big deal. That's why everybody is so concerned about it and kind of why you see everybody talking about the yield curves. So that's basically just what it means and how to think about the 10-year yield versus the 2-year and why the spread is so important. So now you might be asking yourself, well, if everybody can see how bad the market fundamentals are, right? Obviously, if you think about it from a macro level, there is nothing that is saying that this market can really move back to new highs. And that's what everyone who is either a perma bull, they have to be bullish, they run net long 100% of the time. They start to think, now that everything is so public and everybody knows how bad it is, that's when people start to come out and they try to catch bottoms, right? And it's funny because that mentality is definitely a major aspect that keeps these bear markets going lower. When you don't have any fundamental catalysts and people start trying to catch bottoms, they start saying, oh, everything is priced in, that especially with earnings season, you see stocks just dump in earnings. Everyone assumes that everything is priced in. Walmart, they all thought it was priced in. Then that's got slammed down 10% yesterday. Microsoft, I think Microsoft is actually up a little bit in the pre-market. I'm sure people are going with that it was all priced in. And it's interesting because one thing that I've heard, I remember seeing this on Twitter from someone I follow, a very successful hedge fund manager. His name is Michael Taylor. I definitely recommend you guys check him out. But one of the things that he said is that bear markets oftentimes are obvious, right? And that's kind of why they are bear markets, because people have to be long, right? You're taught to constantly buy dips no matter what. You have 401k flows coming in. There's always going to be people buying. There's always going to be some form of support, and people are always going to be looking for reasons to come back into the market and catch these cheap prices, right? And that's kind of the reason why they can stick on and grind lower for so long. You've seen, in this one, I mentioned how there really haven't been any limit down days. We haven't had any crazy flash crashes. We've had the 2, 3, 4% weekly losses, and those kind of just grind lower. But we haven't had that like aggressive sell-off that we saw, especially last year. Or 2 years ago, we had a ton of those back when the market initially crashed from COVID. But we really haven't seen any of that this year. And now you're starting to see, people are thinking that it's priced in. They're just going off their valuation levels. But the thing about that is when it starts to become obvious and everybody is thinking, oh, well, everyone knows this, right? Everyone's bearish. Everyone must be short. That's kind of just an assumption. It's never really true because people are naturally always going to be long. And when you have that mentality, you're always going to have that buyer come in. And that is kind of what fuels the move and perpetuates that move lower, because there's always people coming in to buy into these, what might seem like an obvious bear market. But that's just kind of the psychological reasoning behind it, and why you should never assume that everything is priced in, because at the end of the day, that is likely just an opinion. It's not following any data. It's not following the cycle. So stick with the cycle and stick with what the market is signaling. That's why we have all of our global macro dashboards here to take a look at the bigger picture. And even if something might seem like it's getting too bearish or too bullish, we can read and react to what the market is doing, attempt to quantify, how it's moving, and try to execute within a probable range here. That's why we have our volatility ranges. So now let's just jump in, look at our US equities dashboard. Really no changes to any of the trend signals. We mentioned that last week. We were getting bounces and squeezes to lower highs on low volume, and there are really no changes to that longer term trend. So that's when you have the best short selling opportunities. We now have a bullish trend signal on utilities. So those are now on our volatility signal, bullish trend with positive price momentum. They are moving back into overbought territory, so I wouldn't want to buy them here. I wouldn't necessarily look at this and assume that it's bullish for the entire market, that you're starting to have sectors flip into bullish trend territory. Utilities are definitely in their own lane here. That's probably the most risk-off sector that you can find, so that's what investors are buying during bear markets. So bullish, if you are looking to go long on dips, I'd be looking to buy utility stocks. We have our custom sectors here. If we take a look at our utility sector, you can see most of the names under the hood have at least positive price momentum, and a lot of them are starting to flip to bullish trend. So those are the names we'll be looking for. But if you look at our ratios here, this is based on upside versus downside. In that volatility range that we have, a lot of them are starting to signal overbought, so not the time to chase them here, but just put it on your radar. Now you can have something to look for when the market does take another leg lower. But yeah, that's really it. If we just jump into TradingView one more time, we'll see that we had a great short selling opportunity in retail, got absolutely slammed from the top end of the volatility range here. Tech, that's been a great short. It's down hard again yesterday. We mentioned that we were buying some the inverse long ETF of this. So TEX is the ticker for that. It's a 3X levered inverse ETF. That's kind of a good way if you're looking to quickly trade something. So we were buying that. We were selling some yesterday. Might be able to buy some more today. Looks like we're up a little bit in the pre-market for Microsoft. And if we take a look at Bitcoin, this is another one that we highlighted. It was not even close to breaking out from a trend perspective. We had it last week towards the top end of its volatility range. As we mentioned, we warned subscribers not to chase that move. That's probably one of the worst spots that you can buy when everyone gets sucked in, when it starts breaking above all those moving averages. You know, we mentioned all of the wedges that we saw on Twitter. Don't want to be chasing into all those breakout patterns, but that's still back down towards the lower end of its range here. We'll probably get a big move today after the Fed meeting. But yeah, that's kind of all we have for today. We have the Fed meeting at 2 and then Powell speaking at 2:30, and tomorrow we have GDP in the morning. So we'll have a lot to go through tomorrow. If you guys like these pre-market updates, please hit that thumbs up for me and subscribe, and I'll catch you tomorrow morning. Peace.